Okay, so let's kick off with the webinar proper. Okay, here are the good-looking panel members. Okay, so we will kick off with a poll question, and why are you here today? Why are you interested in the FATF report? So I'm going to hand you over to the poll master, Kevin. Can you run the poll? Okay, so there are three options. So you are part of the crypto exchange, or you are part of a crypto intermediary. So that's option one. Option 2B, rather, you are part of an FI dealing with crypto intermediaries, whether you're a fund manager or a bank, you're a friendly bank that gives accounts to crypto intermediaries. And C, that you're a fanboy or fangirl and you like the regulatory subcommittee. So please vote. As you can see, we try to keep things lighthearted because it's 3 p.m. on a weekday. Are the votes coming in, Kevin?
Yes, they are. They are.
Okay, wonderful.
So I think just give it maybe another 15 seconds. Okay, I think we should end the poll and shall share the results.
I see.
Nice.
We got good fanboys and fangirls.
As we suspected, that probably is the main reason why you guys are here. Okay. Let's move on then. Okay. Now, I think most of you here would know who the FATF is, but if you don't, maybe just a very quick 101 on the FATF. Now, imagine the fear that if you belong to an FI or a soon-to-be licensed under the PSA, a crypto firm, imagine the fear that you have to be when the MES comes knocking at the door, inspecting you to ensure compliance with the MES notices. Now, flip it the other way around. Imagine the MES's fear when the FATF comes, having their mutual evaluation exercise, asking if the MES has put in place a regulatory framework that complies with the FATF recommendations. So the FATF is the supranational that sets out a global set of standards for money laundering or anti-money laundering, anti-terrorist financing. They've been extremely successful and effective in implementing the standards worldwide. Now, Singapore is a member of the FATF, and I think it is fair to say that a lot of our money laundering laws or the MES notices have changed over the years in light of the FATF recommendations and the way the FATF recommendations have developed over the years. Now, so you can imagine the very influential status of the FATF. Now, in connection with virtual assets, virtual assets is another the FATF lingo for cryptocurrencies. The FATF has earlier on implemented standards for virtual assets, saying that the recommendations also apply to virtual assets. So Chaikit have been at one of the FATF meetings that discuss virtual assets, and he will share with you that it was a very fun meeting. Chaikit, you want to share some anecdote?
Fun meeting, Chaikit.
Fun meeting. Well, it's actually quite an honor to be invited by FATF, and so that you know, FATF obviously know who's who in the zoo globally, and this is actually back in late 2018, where they typically have this fintech/regtech forum where they engage the industry participants around the world, and I was privileged enough to be invited to share my thoughts, and that was around to talk about it was really just before the virtual assets service providers guidelines were actually finalized in 2019. So they were actually looking for feedback from the industry, and clearly, you know, I didn't do a very good job because I was actually trying to push them to tell them that they don't really need to issue new regulation because the rules are already there. Well, as far as I can share is that I think at that time they were trying to figure out the effects or the potential effects of cryptocurrency, and they have a preconceived idea that cryptocurrency in general is bad. So we're trying to say no, not actually all are bad. There are some good ones, and how potentially there are already solutions out there that can help to mitigate and manage the risk. So it's a forum that they typically will do on a periodic basis. So if any one of you are making enough noise in the market that they can get you into one of these sessions, it'll be good opportunity for you to see what's going on.
Okay, thanks, Chakit. That's certainly more interesting than my little anecdote attending an FATF meeting in Paris and enjoying the coffee. That's about all I can say for that meeting. So moving on. Okay, why does this report matter? Now, I think this chart may sort of illustrate the point. So we've got at the top of the food chain, the Financial Action Task Force, and promulgating its recommendations. And typologies like this are very influential because this set up scenarios. And I think prior to this, there might not be enough guidance within the industry to set up the different scenarios where cryptocurrency transaction is deemed to be a red flag, right? And then of course it impacts regulators such as the MES and also other regulators in jurisdictions who are members of the FATF. So in our context, the MES issues the AML CFT notice to a financial institution, your MES 626 or the SFA 04 if you're a fund manager or broker dealer dealing with cryptos. But of course, if you're a crypto intermediary, we now know that exchanges and dealers, OTC dealers in particular, are licensable under the Payment Services Act. But going forward, the MES has issued a consultation paper. I think we had an earlier session where there was a proposal to even extend it to other forms of intermediaries. So long as you broker a crypto deal, you will be caught. So the crypto exchange or intermediary would, therefore find this report extremely relevant because they are, front and center, right? So there are many transactions which may or may not be deemed to be red flags. And of course, if you have a customer interfacing with the exchange, then there are also certain typologies which talk about how that customer is involved in the transaction. And of course, from the perspective of the bank or the broker dealer or the fund manager dealing with the crypto exchange or intermediary, again, it is relevant. So this set of report is also relevant for that FI. So that sketches out the broader picture the backdrop for this report. So moving on.
I think if I may say a few words on that, Nizam, in terms of my perspective, in terms of the importance of this report. Obviously, we all aware now FATF has issued last year the travel rule in relation to the transfer of cryptos and also some of the standards, and you referred to as well the 5 regulated activities that FATF is expecting. So if you are involved in any shape or form with digital tokens, or as they mention it, virtual assets, you will probably be required at some point, depending on where you are regulated and jurisdiction that we are under. Obviously here in Singapore, MES has issued ESN 0102, whereby, and I think we're going to elaborate a little bit more later down the session, in terms of the importance of complying with some of these scenarios that we have. I think MES probably expect us to incorporate some of these controls in light of the fact that they have issued a risk assessment a few years ago in terms of outlining the fact that crypto is cross-border and the fact that it's moved fairly quickly. They deemed it as very high risk. And now, of course, the recent report about banks being obviously found to be lacking in money laundering and controls. I think that this particular report is something that it's a warning out there to obviously the players that we need to take AML and CFT seriously. So I think it's just this, and the fact that they use the words red flag, I think it's important that he wants to highlight that attention to everyone. That's my take of this particular report.
Thanks, Azman. I think it's also worth reiterating that within the crypto community or in MES talk, digital payment token service providers, there is a specific AML notice that applies to this community only. And that goes a little bit beyond the other notices that apply to the other FIs. So yes, we are a very special group. And I think the thing about the AML risks of cryptos that's often been said, I get a little bit upset because, it tends to also not talk about some of the very strong mitigants that exist because a crypto transaction is on the blockchain or, some form of ledger that is permanent and it's going to be a permanent record audit trail of your crime. So you really can't be very bright if you want to launder funds using cryptos. But we'll get more into that in a bit. Now, the FATF was, very cautious about how this report might be perceived. So it actually stated this in as part of the report. It's not meant to be used as a regulatory tool for compliance or examination purposes, or a checklist when supervising financial services or all the other FIs that are relevant. And not all indicators are applicable to all jurisdictions or all institutions. So it's a way of saying that, look, this is not a definitive list. It doesn't mean that, the MAS is going to check you against all these red flags. But having said that, I don't know, I take this with a pinch of salt, and I don't know whether the panel might feel the same way. I think, remember that MAS is part of the FATF, and I think Chai Kit, when he attended the meeting, would probably see the MAS officer across the table. I don't know. I mean, your thoughts, panel. How influential is this report?
Actually, I think well, leaving aside the fact that a number of key jurisdictions in the world are obviously full member of FATF, and Singapore being one of them, and MAS being quite forefront on this, sits on quite a number of the policy committee or working group within the FATF organization, which is actually good in one sense, because I think if you think about it, the participants or the industry within Singapore's context complies with the Singapore standard, you would be quite certain that you are benchmarking to the, I would say, the most stringent or the most forward-looking standard that maps to FATF standard, because they are part of the people that sets these global standards anyway, right? So that's the basis. Now, the second point I would like to make on this particular report itself is that I don't really think we need to think too much about the report, because to be quite frank, if you follow FATF or even the sub regional groups of FATF, like the Asian ones, or the Caribbean ones, and so on and so forth, each subgroups or within or Asia Pacific ones will come out from time to time typologies and red flag indicators for different sectors. Now, it could be for banking sector, it could be from even quite recently, or actually earlier, late last year, they revised something to do with red flag indicators for the DNFBP sectors, which in short is designated non-financial businesses and professions, right? So they do red flag indicators all the time, and that will change from time to time and from even region to region, and that sets the basis of their global work that they do in working groups and and so on and so forth, and then they consolidate it up to come up with reports like these. And that's why you see in this report there's a lot of case studies that spanning from Korea to Africa and to various other regions. Now then, from there, each country, like in Singapore's case, like for example CAD, will then compile these and then contextualize it to Singapore's context, or cases that they have seen within Singapore's STRs that's been reported before, and they then publish similar red flag indicators by sector. So I haven't seen one published by CAD on crypto sector yet, so this may be the the preamble, so do look out for it. But for the other sector that's been around for a long time, CAD publishes these red flag indicators all the time, and it encourages different industry associations or bodies to then or regulators to disseminate this into their respective regulations. So you can see even within MAS notices and guideline, at the back you will have all these suspicious transaction indicators at the back of your guideline as well. So this is how this report will be used in the future.
And I think
that's the thing, right? Our sector is more international. I think what's special about this report is it covers the globe.
Yes.
Right.
No, correct. As I said, most of the time it will come out with either the like FATF, APEC group, or for this case it's FATF itself will come out with reports like these that consolidates. And like recently they came out with typologies for COVID-19. And that is something that people will use and then try and create or curate their existing red flag indicators for different sectors as the regulators fine-tune their guidelines for respective sectors that they regulate.
Yeah. I think in terms of this relevance of this particular report and the question that each of us as the businesses or FI needs to consider is to what extent that you are bound under the MAS notices TSN 01 or 02. And clearly if you are, meaning you are a DPT service provider and therefore you're required to comply, I mean, you would see that under those notices and guidelines, there are a couple of standards. And I think to the extent that some of these red flag indicators have highlighted to you, you can probably assume at some point MAS or any of their bodies, I think the one that you refer to is probably CAD or the criminal branch will come up with similar standards or indicators that you have to comply with. So exactly. I think essentially, you have to assess that for yourself first.
Correct. And to be quite frank, that's as an aside, I teach AML to the corporate secretary sectors for the whole of Singapore. So my take is this, right? Where people look at the whole list of red flag indicators that is presented by either the CAD or the MAS or by ECRA or by whoever regulator that regulates the sector, people tend to take it in a binary form because the reality of money laundering or potential money laundering or counter-terrorism financing is not that one red flag indicator is the be-all or end-all. It could be a combination of indicators, or it could be a combination of indicators over a period of time involving a number of people that results in you having the suspicion about something doesn't smell right about your clients' activities on your platform, right? Whether it's crypto or otherwise. So that is an indicator which is not meant to be saying that if you have got this indicator hit, then therefore it is a suspicious transaction by itself.
That's right. It's not conclusive, and that's, I think, the key word is the fact that it's an indicator or a trigger for you to investigate in light of the other factors or variables. For instance, the user's profile or his other activities and so on and so forth. Whether in totality that you can then assign whether or not it's suspicious enough to warrant a report or SDR to be filed.
Okay, guys, I think we're jumping the gun a little bit. We're probably going to talk a little bit more about that going forward. Maybe I can move on and then we can get back to the points that you raised, which are good ones. Okay. So the next point the FATF made is this, that competent authorities are encouraged to disseminate report to reporting entities and conduct engagement and awareness raising sessions with them to promote their understanding of the report. So we scored a lot of brownie points with the FATF for organizing this session. I think this is exactly what we're doing, conducting engagement and awareness raising sessions. Now, I think if there are issues as well, and I think when you come across some of the examples, I think we might have a discussion on that, where you think that some of these examples might be overly conservative or might be overstating things. I think we can think of one of the things that we discussed within the committee is whether we want to, put in some written response to the FATF, but we'll get to that in a bit. Okay, Now, we're going to do another poll. Poll Master Kevin, how materially will the FATF report impact you? What is your view at this stage? So let's run the poll.
Okay, launched.
Okay, so the three options are somewhat, B, materially, and C, not at all. So please vote and let us have your views. So this is where we have to kill time within a minute. And so I didn't prepare any bad jokes today, so I will leave it to the panel to jump in and contribute. Okay, let's see what the results are.
Okay, just probably 10 seconds. I can still see people clicking on it. Okay. 5, 4, 3, 2, 1. Okay, just let me end the poll. Share the results. There you go.
Okay, so I think the majority of respondents felt that they will be somewhat affected by the FATF report, and then a smaller percentage material impact. Probably you fall within the regulated FI or crypto intermediary. And not at all, that's probably the fanboy group of people that are here because they just like seeing us. So thank you for that. Okay, now let's get into the, okay, sorry, before we get into the report, I think let's understand what the current MES notice says, right? I mean, I know for the other FIs, you've got 626 and SFA 04 and 04, but assuming your crypto exchange is PSN02. So there are the usual requirements for CDD. You know, somebody signs up, there's non-face-to-face or face-to-face KYC. Most of the time is non-face-to-face, ongoing monitoring, STR filings. Those are the standard requirements. Now, I think when you look at a lot of these typologies set out in the FATF report, a lot of them talk about ongoing transactions. So let's look at what the MES says for ongoing monitoring obligations under PSN02. So there is an obligation for you to scrutinize transactions consistent with your knowledge and the profile of the customer. Of course, you need to do risk mitigation where you receive cryptos from non-FIs, non-regulated financial institutions, and you are supposed to pay attention to complex, unusually large or unusual patterns or transactions for which there are no apparent economic or lawful purpose. Now, this really mirrors the notice that applies for the other FIs as well. So nothing really very particular about crypto transactions, certainly not to the same extent of details that are set out in the FATF report. There's also a prohibition against cash payouts above $20,000. Sorry, pardon the typo. Unless certain mitigants are in place. Azman mentioned the travel rule, and we had an earlier session on the travel rule. So any transactions above $1,500, again, it's a quite arbitrary amount, which really mirrors the threshold for cross-border transfers for fiat. So 1,500 for cryptos is really quite meaningless, if you ask me. Now, so that's the MES notice, right? And then we know that the MES also issue a set of guidelines. The guidelines sort of flesh out some of the requirements of the notice. Now here is where the MES does go into some detail, but again, generally not as detailed as the FATF red flags report. So they've spoke about the potential use of DPTs for ransomware or malware. I think, Ian, you do some work in terms of screening for wallets for this. Some marketed products for some ICOs which are scams or e-commerce which are scams, where the e-commerce sites promote tokens, for instance, where the tokens are linked to hacking activities, and then they frown upon anonymizing features, tumblers, mixers, privacy coins. So that is a no-no. And if you've applied for the license, you know that the MES will ask you specifically on this. Mule accounts, proxies. There are some typologies set out in Annex B to the guidelines. Now, interestingly, the MES actually refers financial institutions to the FATF links. So that brings us to the earlier point, how relevant is the FATF report? Technically, the MES says go and refer to the FATF for fuller information on cryptos. So this is a current state of play, and for all intents and purposes, this is the actual regulations, the notice has a force of law. The guidelines, add flavor to the force of law. Now, Ian, do you want to say something about how, from what you're seeing, payment services firms are handling the issues of, especially the guidelines that set out some of these red flags from the MES's perspective?
Sure. So just to add a little bit, what Chaikit and Asman had said before, I totally agree that this document should serve as an important reference point, right? MES does play a huge role in influencing some of the recommendations that FATF have put out in terms of what relates to virtual assets, right? And we can draw reference from the fact that when the travel room out, MES is one of the first countries to implement it, as well as what you've pointed out in the guidelines to the PSNO2 notice. Some of the examples of suspicious transactions do overlap with what we're seeing over here in the FATF red flag indicators. So I think the red flag indicators is an important reference guide, but then as pointed out by some of the other panelists as well, it is intended to be more of a global red flag indicators, whereas regions would then perhaps come up with their own. So like what Chaikit said, I wouldn't be surprised if in Singapore there is a red flag indicators that would be produced at a later date that is more relevant to us. Now, in our interactions with a lot of our clients, what we've actually seen is that actually prior to MAS releasing their PSNO2 and even prior to the FATF releasing their red flag indicators, right, a lot of the larger companies that we deal with had already been implementing AML frameworks that overlap a lot with what these red flag indicators are already highlighting. And that's because if you look at the red flag indicators, a lot of them does draw reference from traditional transaction monitoring rules, right? With a slight portion then incorporating things like anonymizing features, ICOs, and features that are specific to crypto. But by and large, you will see that a lot of it comes from the traditional space, right? So that being said, I think it is very important for us to pay attention to what FATF is saying and be aware of the role that it plays in influencing our local regulation. But at the same time, recognizing that crypto is a new beast, right, which will have then its own typologies that we need to develop and then educate the regulators, right, is also important moving forward. Yeah.
Okay, thanks very much, Ian. Let's move on to the actual FATF report. Now, this is a backdrop that the FATF mentioned. So, as Chaikit mentioned, I mean, she was there at the meeting. The FATF is concerned about the potential use of cryptos and as well the role of service providers. So the FATF has issued standards in October 2018. So this, from a global perspective, so all the member firms are obliged to comply. Now, what is the purpose of the report? So the FATF says that it's meant to assist financial institutions, reporting entities, DNFBs, the non-financial institutions, VASPs in identifying money laundering and terrorist financing activities, also for CDD, ongoing monitoring and filing of STRs. So here the FATF is saying that, look, this report is meant to guide you. So you know when a transaction is deemed to be a red flag for money laundering or terrorist financing. Now, it also goes on to state that FIUs, financial intelligence units in Singapore is the CAD, enforcement agencies, the CAD as well here in Singapore, as well as prosecutors, the AGC, may find the report useful. So it's meant to also guide the investigations, law enforcement and prosecution authority. The FATF says that it's based on more than 100 case studies, assembled within 3 years from member firms. So it's very quick to say that this is not an exhaustive list. There might be other typologies. You will find that for a lot of these typologies, it's very similar to fiat currencies, although some are very specifically cryptos. Now, this is a point that Asman made in the beginning, that the mere presence of a red flag Chaki also made this point, doesn't necessarily, conclude that there is suspicion of money laundering or terrorist financing, but it prompts further monitoring and investigation. So please understand this point. It doesn't mean that you have a red flag, you straight away file an STR. So your obligation is really to investigate the red flag, verify whether it's legitimate or non-legit, and then have that considered discussion internally whether or not to file an STR. Because the FATF also said that clients may have viable explanations for some of these red flags. My comment is that there's no reference at all. I mean, there's a lot of talk about the evil nature of cryptos, but there's no reference to the fact that actually cryptos leave a permanent audit trail. And there's actually been a lot of enforcement action taken on account of the audit trail on the blockchain, leading to very successful prosecutions. Yeah. So I'll just pause here. Any comments? Azman, you want to go first?
Yeah, I want to say something about that. I mean, essentially, these indicators being red flags, and depending on their relevance, whether or not, for some of us, more so than others. And obviously, if they do apply, then the expectation by the regulatory, and in this case, MAS, is for us to embed within our operations, within our processes, within our system, some of these triggers. And therefore, that involves a lot of, obviously, investment. It involves a lot of, understanding of measures and standards to apply. So, I mean, given the fact that, it's in itself just an indicator, and, and of course, it's important to understand, whether or not individually it applies to you or your business. I think it's important to make that assessment, whether or not it applies and whether or not there are expectations by the regulatory authorities for us then to implement within our system and our processes to make sure that we have these relevant triggers and indicators in order for us to do further due diligence, either through enhanced CDD or engaging the clients before making that assessment before filing an STR if it's appropriate. So what I'm trying to say is it does involve a commercial decision, further investment, that I think it's not addressed here. And I suppose, the regulatory authorities are fully expecting, compliance in that regard. So it's just a point that I want everyone to consider at least.
I think
because
my take, Azman, is that, I'm actually, the fact that the FATF says that law enforcement agencies and FIUs and prosecutors may find this report useful. I mean, it's a very strong prompt. So if you're a regulated financial institution, the first thing you need to do is to just check whether your compliance manual actually needs to be updated in light of these red flags report. I mean, yes, of course, red flags are just red flags in what you do, but within that framework, you might need to update what these red flags are, right? I would also then look towards my RegTech providers, especially if I'm relying to a RegTech provider to provide ongoing monitoring or even CDD services, whether their system actually takes into account some of these red flags. I don't know whether that's a fair assessment. Chaikit and Ian, I mean, you have any thoughts on that, being RegTech providers yourself?
If I go first, Ian. Now, I think taking a step back, I'll come to this in a while because I think it's important to make the distinction. Now, as with all things, these indicators or these examples of cases that have been investigated before and people have been prosecuted and so on and so forth in various countries, and which led to the writing up of this report itself will mean that tons and tons of investigation hours have taken place, and it may involve the crypto participants themselves, as well as in some cases, if you read the report itself, the FIs themselves, the banks themselves making the relevant respective STRs to the relevant authorities, right? So you have the benefit of the ability to look at everything, and then you come up with this report. But to one intermediary within the chain of activities, to be able to have the benefit of the holistic view is, number one, unrealistic. Now, number two, I think what is important for crypto participants or intermediaries to think about is really to go back and consider what is the compliance framework, what is the internal control methodology that you would like to have, and which gets back to your risk appetite, and which is why the pinnacle of even the FATF 40 recommendation number 1 talks about taking a risk-based approach. So it means that if you're willing to take more risk, then you do more work. If you're not willing, then you do you may want to if you're willing to do more, take on more risk, then you need to put in more controls, to mitigate the risk, because you can't be completely exposed. So if you split up the red flag indicators as potential areas for you to beef up your controls in 2 parts, one being your preventive control, which is your onboarding processes. Maybe you may limit the number of wallets and a user can have with your exchange, to be interacting with your exchange. And for example, you don't allow third-party withdrawals and so on and so forth, right? So these are preventive control that you put in place, which you can actually prevent these red flag indicators from even appearing, because you are preventing some of these outcomes. Now, if you can't prevent all eventuality, then you put in place detective control to detect certain activities, like what has been flashed out here, something that's unusual, and that's where people like Merkle science comes into play. That is the combinations of control mechanism that you need to think about, because the regulator cannot decide this for you, because you make the decision on how much risk you want to take in running this business. And then ultimately, your residual risk have to be something that you can accept, and the regulator think that it's the right level of risk, having considered what kind of control you put in place. Are you, a cowboy, or are you, putting safeguards where you should be putting safeguards? So I think we need to look at it in that angle in order to make sense, and not to look at an FATF report like this and say, okay, I must do this 20 things because the report says so, because it's not how controls should operate. And then to Nizam's point, whichever service provider you use then must be used to fit into the respective control, whether is it preventive or detective segment, and then they should address those risks that you want them to address.
Okay, thanks, Jacket. Ian, your thoughts on this?
Yeah, so just to add to that, I think what Osman pointed out as the commercial, this being a commercial decision, the commercials of engaging a RegTech provider for something like this has to be pointed out, right? If you look at the case study that I think was inside the red flag indicators, case study 12 talked about a money laundering scheme where stolen virtual assets were routed through like hundreds of automated transactions and multiple exchanges. And I think with cryptocurrencies, the ability for these criminals to layer their virtual assets using software is immense, which makes it difficult for people to use traditional software in order to detect, right? So if you look at a lot of these red flag indicators, the ability to pick up mixers, the ability to pick up on darknet marketplaces, certain suspicious transactions, it's mandating these crypto companies to use a provider like ours, not to hard sell, but I do think it's placing a unfair burden on these virtual asset providers, right, who wanting to come into the space. Now they have to not only consider, your traditional KYC, your traditional fiat monitoring. Now you have this additional burden of having to engage a crypto transaction monitoring provider. And then now with the travel rule in place as well, it's another additional cost, right? So having to balance all these and then finding the right proportion in order to manage your risk, I think is a huge challenge for these crypto players, especially since a lot of them are new. They may not have the kind of financial backing that the traditional banks and financial institutions might have. And that's one of the reasons why, from very early on, when we were trying to build a system like this, we realized with ever-changing regulation, our clients would need to be able to create new red flags or alerts on the fly, right? And so I think it's important for you to then choose a provider in this space that recognizes the difficulty that cryptocurrency companies have, right, in the ever-changing regulatory landscape, and then figuring out how they can help these clients balance, right, to achieve a appropriate cost to risk decision, when choosing a provider.
Thanks, Ian. If I may move on. Okay. Just a couple of general comments that the FATF made at the beginning of their report. they said that they have seen the use of cryptos for money laundering or terrorist financing. A lot of these actually relate to the fact that the predicate offenses are, crimes, obviously. For instance, sale of controlled substances, drugs, firearms, fraud, tax evasion, computer crimes, child exploitation, human trafficking, sanctions, evasion, for the typo, terrorist financing. The most common category of misuse of controlled substances. And the second most common category, fraud, scams, ransomware, and extortion. So that's pretty interesting. So all the nasty stuff, but increasingly when you look at the use case for scams, it's actually ransomware or extortion. Ian, your thoughts? Have you seen this actually been prevalent?
Yeah, so actually, one of the early use cases for cryptocurrencies, undeniably, is through the sale of illicit goods online, right? So a lot of deals, darknet marketplaces that took place over the past couple of years, their primary go-to form of transaction would be Bitcoin, right? With the rise of privacy coins, we've seen, more criminals perhaps turn to that, but undeniably, crypto is still the go-to. And so even if you look at a lot of the spike in, I think, online purchase of illegal goods, a lot of it was largely driven by crypto becoming more mainstream, it becoming more accessible, right, for individuals as buyers, as well as, I think, for criminals themselves in terms of cashing out, be it through OTC or unregulated exchanges. So definitely, I do think that cryptocurrencies is heavily being involved in all these offenses as listed over here.
Let's move on to some of the typologies. So, okay, the FATF has pointed out some red flags when it comes to the size and frequency of transaction. So, okay, it sets out certain examples like small transactions in small amounts to keep below record keeping or reporting thresholds, very similar to fiat. Multiple high value transactions, for instance, within 24 hours, a staggered or regular pattern, or transactions to a new or inactive account. Again, very similar to fiat. And then it goes on to say transferring cryptos to multiple intermediaries for no economic reason, or where AML laws are lax. I think this also mirrors some of the fiat requirements. But it does, to me, that is probably a point worth noting if you're dealing with cryptos. Depositing cryptos at an exchange and then withdrawing when you didn't exchange it for any other cryptos, or you convert it to other cryptos without business logic, or you withdraw cryptos immediately to a private wallet. I think there are similar scenarios for fiat as well. And then it goes on to say accepting funds suspected as stolen or fraudulent. And yeah, here where they are linked to addresses which are linked to holders of stolen funds. So my comments is that some of these are covered in the MES guidelines. So if the MES, the MES guidelines actually refer to large transactions, frequent high value transactions, or transactions with no economic sense. Any thoughts by the panel on any of these red flags?
So I think from Merkel science perspective, even before all these red flag indicators came about, we were trolling through the fiat red flag indicators to decide what we wanted to incorporate onto the platform. What we realized is that a lot of these red flag indicators that you see over here, yes, they are suspicious, but they fail to take into account that some of these are the usual transaction patterns of crypto traders, right? So the fact that, there's a lot of material online that says that people shouldn't leave their crypto in exchanges in fear that it might get hacked leads to a lot of people just withdrawing everything at the end of the day, right? A lot of these exchanges also run promotions where, if you deposit a lot of your crypto, you may get some kind of kickback in the form of maybe 2% in a local coin, which again leads to a lot of people moving in their crypto and then immediately withdrawing, just trying to hunt for that promotion, right? So what we've seen is that definitely they are indicative of perhaps some suspicious activity, but as what the panel had highlighted, you can't look at any of these in isolation, right? The context is very important. If you know that exchange is running some kind of promotion that is then attracting this kind of behavior, that all must be factored in.
Thanks, Ian. Moving on.
So do you see the typology as dampening some of the activity?
I think it would depend to what extent the exchange is actually following it to the letter, right? Are they flagging it up in isolation and then causing trouble on behalf of their clients, who I can tell you with so many exchanges out there, they're always looking for an exchange which gives them the best experience, right? And so they aren't that forgiving because they have that many options available. But at the same time, that has probably led exchanges to realize this and take a very lax approach, right? So I think, going back to what I said at the start, then it depends on the extent in which the exchanges or crypto businesses are enforcing it. And if they are enforcing it very strictly, they're taking these in isolation and perhaps not bothering to do follow-ups as to why their customer might be interacting with their business in such a way, then it could put a damper in their business. Right? But on the other hand, if they are investigating it and then suspending their client's account in the meantime, again, that would also give the customer a bad experience. So it is a commercial balance decision that has to be made.
Sorry, if I add one point here, perhaps a little, I would say, definition on what amounts to no economic benefit or no economic reasons. It's a very, very broad thing, right? Because quite frankly frankly speaking, if you think about an exchange being an intermediary that facilitate people to swap, whether it's it tokens or even if you think about it in the fiat world, or a broker dealer, people give you the money to buy some shares, you are actually changing a dollar into a holding, right? A security. So, and it's not for the exchange, I suppose, it's not your problem if, let's say, your client wants to buy high and sell low. I mean, that itself is no economic reason, because who wants to lose money? But if he's a bad trader, who are you to say that it's money laundering? I mean, it's something to think about, right? How do you actually contextualize that into a process that you can monitor without having everything being flagged out in a very non-operationally viable fashion?
Yeah, that's a tough one, isn't it, Chaikit? In the real world, there are different shades of gray.
Exactly. That's my point. That's my point.
I think
to a money changer as well. Sorry, go on.
This is essentially the risk-based assessment that you're talking about earlier, and it's very difficult in a practical sense to really define some of them because of obviously the fact that we do not have all of the relevant information in relation to a client. Like you said, a lot of these things could happen because of a real legitimate reason. But the fact that you're selling high, buying low, does in fact would trigger some sort of indicator, especially if the amounts are large. So, but clearly from the business perspective, are we then expected to be that policeman to go and inquire and find out and incur all of this additional time and resource to figure out whether or not it's a legitimate transaction? So these are some of the difficulties that I was just trying to flag out earlier on in terms of trying to find that appropriate risk level that we can then accept and then justify it, obviously, then to the regulators as being appropriate.
Well, I mean, it's not new. I mean, getting the right risk level, because a lot of these, what is an economic benefit, I mean, or brings value, I mean, that also exists in, let's say, securities trading or other investment products.
Correct. Correct.
So to the extent those are existing problems.
Clearly. But because this is new and this relates to crypto, and we obviously need a lot of discussion and to socialize and come together to come to some sort of a common understanding or in terms of what is the appropriate measures and standards to apply. That's, I think, is something that I would like to push forward in terms of at least, the members in this whole crypto community, given that the fact that this is a fledgling industry and there's a lot of scope for us to, share and decide together what would be an appropriate level. And if at some point where it becomes more mature, like some of the securities industry, then it becomes, standard.
Yeah, I think we'll get to that in a bit on the next steps. But maybe before we go there, I'd like to move to another cluster of red flags. And I think this cluster would be very interesting because they talk about anonymity. And this is quite particular to cryptos. So you'll find a lot more highlights over here. Now, the MES guidelines actually frowns upon anonymity, but it doesn't go anywhere near the level of details that the FATF red flags have set out. I mean, some of these, okay, we can argue whether they are overly conservative. Okay, but let's start. I mean, for a start, the FATF red flags report flags the use of anonymity enhanced cryptos or privacy coins as a red flag in itself. And then it goes on to say that where people convert, let's say, cryptos on a public blockchain like Bitcoin, Ethereum, and you convert it to a privacy coin or an anonymity or an AEC, that is another red flag in itself. And then it goes on to say this, where you deal with unregistered or unlicensed VASPs or P2P exchanges. So they actually flag out, you know, non-centralized or decentralized exchanges as a red flag in itself. Another red flag is abnormal levels of cryptos cashed out at exchanges. Again, it doesn't say what is abnormal, what is not. The nature of crypto transactions, they tend to be quite high levels anyway, but we can talk about this in a bit. Transaction patterns making the use of mixing and tumbling to obscure the flow of funds. And then it talks about wallets linked with nasty things, darknet, mixing, tumbling services, gambling sites is a red flag. Illegal activities, for instance, ransomware, theft reports. Hardware wallets is now a red flag. Again, you can argue whether that is again overly conservative, because people use hardware wallets for security reasons or other reasons, right? Use of proxies or DNS to suppress domain names. Seemingly unrelated wallets controlled by the same IP address. So again, the use of right text solution to pick this out. Now, ATM kiosks in higher risk areas where AML laws are lax. So that's another red flag in itself. Now, I'm going to pause here. I think that there are lots of things that we can discuss. Anybody wants to kick off, whether you think that some of these red flags are okay or overly conservative? So the panel is stunned.
Allow me to go then.
Yeah, go.
I don't think it's overly conservative, right? Because again, going back to what was said before, none of these are conclusive off by itself. I think we do need to bear in mind that the point of this document is to make the perhaps less familiar with crypto individuals educated on what they might have to look out for, right? So a lot of the case studies that were put inside this also serves as a good reference points for companies looking to enter the space who's unfamiliar with what kind of typologies they need to look out for, unfamiliar with what criminals might have used virtual assets for in the past. And so on your point, for example, on hardware wallets, yes, they do highlight hardware wallets as a risk for anonymity, but at the same time, they did say that it is specifically because hardware wallets poses a risk which allows people to transfer virtual assets across border, which then cannot be detected by on-chain transaction monitoring tools like Merkle Signs, for example. But right at the start, the paragraph that introduces the section on anonymity also highlights that hardware wallets may be a legitimate way for companies to secure virtual assets against theft, right? So everything must be taken into context. So I don't think it is too conservative. I think it's always good to educate and put as much information out there to make people aware. But then again, they just also need to be aware that none of these are conclusive, right? And so to weigh that up against the other risk factors when they're making a decision.
If I can add, I think to some extent, if you take a step back, it's always good to take a step back and see the bigger picture and why things exist. Now, there's always a conflict, I don't think we should pretend that there isn't. The anti-money laundering requirements or standards, as well as counter-terrorism financing requirements, will always be asking for transparency. Because you need to drill, you need to dig to who actually ultimately owns the asset or who ultimately controls the account and so on and so forth. Now then, with the broad concept of crypto or the anonymous coin, or AEC, for example, or privacy coin, or perhaps with the concept of blockchain that perhaps was initially intended to preserve privacy, that itself is a conflict, right? So I don't think we have found globally where is the happy landing point between the two sets of potentially conflicting outcomes. But given this is coming up from FATF, which is promoting anti-money laundering, then clearly anti-anonymous type of or people trying to hide behind certain tool, or whether hardware or software, it's gonna be something that they will not encourage. It's expected. And so like what Yen says, some of these, there may be legitimate reasons, and you cannot say that you criminalize the use of hardware wallets. That's just wrong. It's just like you can't criminalize the use of thumb drive, right? Because thumb drive itself is being used for legitimate reasons, for storage and whatever not. But some banks or some organizations have, I would say, disabled thumb drive function in their computer because they are scared that their employees will steal data away from their organization. So there are always two sides to the coin. No pun intended. To coin.
I would also add, in terms of the definition of anonymity enhanced crypto, is also quite vague, because I think I'm aware that some coins, they have a feature that you can turn on and turn off. So arguably, if it's off, then it's not a privacy coin. But if it's on, but we've taken the approach that even though they have a feature that can turn on and off, an anonymous feature, we take that as a privacy coin, and it might affect those tokens in the long run. But I mean, I understand the fact that they want to basically bring transparency into the space, but some of these levels and the fact that the description I think lacks certain details and I think further clarification. I think that's, especially when you're talking about the patterns and the mixing, it becomes quite complicated to expect a service provider to be able to, first of all, identify and then make the correct assessment. I think that's the key in terms of taking into account all of the appropriate variables to come to that right decision. That, I think, is part of the challenge going forward.
Yeah, thank you, panel, for your thoughts. I think just to add on, I think remember that there are already existing requirements from the MES that when you embark on a new business or a new product, one of the red flags within that framework is actually whether that new technology or new process or new platform has an element or promotes anonymity. So in that sense, a lot of these examples which tend to promote anonymity, whether consciously or unwittingly, it would definitely fall within that framework already. That's my take on it. Okay, but this is an interesting discussion. I think a lot of these examples might not have been previously discussed, so I think it's something to take note of. I agree with Ian's views that these are meant to be red flag indicators. So again, the fundamental point is this is not meant to be conclusive. So we have to take things in context and investigate further. Okay, and I'll move on to the next set of cluster of red flags. This might be similar to some of these might be similar to the fiat world. And the MES guidelines actually cover customer behavior, CDD related irregularities, but again, maybe not as detailed as some of these typologies. So the FATF report says under the cluster of irregularities during account creation, creating accounts under different names, that's quite obvious. Transaction from non-trusted IP addresses, or from sanctioned jurisdictions, or IP addresses flagged as suspicious. Now, this could actually be relevant for your RegTech provider if they do screenings for IP addresses, or if you're doing it yourself, then you need to think about this. And for merchants, if their internet domain registration are different from their home jurisdiction, during the CDD process, customer due diligence, incomplete KYC, where the customer declines requests for documentation or information for KYC or source of funds purposes. The sender or recipient lacks knowledge or provide insufficient information about transactions, forged documents, that's pretty obvious. And then in terms of profile, customer provides identification or account credentials shared by another account. There's obviously a red flag. Discrepancies between IP addresses associated with customer and IP addresses from which accounts are initiated. Again, that might not be entirely new, but yeah, something to think of. Now, the next point is interesting, where the customer's address appears in public forum associated with legal activity. So this is interesting. So if if you run a coin that's scam.net and that's flagged in some public forum on social media, then that is a red flag in itself. So that's pretty interesting, and this is probably relevant for RegTech service providers to take note of. Previous criminal association, the sender not familiar with VA technology. So for instance, if you have a 70-year-old uncle in Heartland, Hougang, opening an account at a Bitcoin exchange, and when you ask him, he said, I don't know what a Bitcoin is, then that is a red flag in itself. So it actually flags older customers or vulnerable groups used as mules for traffickers or money launderers. Again, that's pretty interesting. Purchasing large amounts of cryptos disproportionate to wealth. Not entirely new, there are probably parallels in the fiat world as well. So again, I'm going to pause here, get a quick comments from the panel members. Anyone?
I think that the technology now exists that we can pick up all these IP addresses associated with, unsavory or the bad actors. So in a sense, it's nothing new, and the technology exists now among the RegTech providers to pick this up. So this one, I don't see that as a biggie or anything difficult for the industry to grapple with.
But I think in terms of the identity, the key here that we are dealing with is the fact that, because the fact that it costs nothing to set up an account, and people are setting up multiple accounts to take advantage of various things, whether airdrops or whatever. And also they are using some of this to sell as their accounts to those bad actors, and those bad actors clearly are using those accounts for nefarious basis and reasons. And we see that in social media, the practice of selling accounts, I think is quite rife in some of the other countries, and we are seeing issues about the fact that clearly these are areas whereby the identity and the KYC is a non-face-to-face. Then the challenge of making sure that it's the right person. And I think some of the measures that we've taken on board is the fact that we do not allow to open the client or the user to open more than one account. Because under the MAS notices, they require you then to aggregate. If you allow them to open more than one account, you're actually obliged to consider them as one series of transactions. So one of the practices and the preventive assessment that we took is not to allow them to open one. Therefore, the challenge is for us to make sure that they do not open, multiple accounts for our platform. But I'm saying the challenge still continues in spite of all of this, and we have to be constantly vigilant to these kind of practices.
Yeah, I think just on the IP address that was mentioned, I'm not quite sure how futile or how useful some of these tools are. One of those things that's quite obvious is that there can be a lot of VPNs around that makes it a little bit hard. And then there's, again, legitimate reasons VPNs are used, and when people are moving around, sometimes you're on Wi-Fi, sometimes you're on 4G, 5G, or whatever, then your IP addresses will sort of change. And that's just because how mobile network is done. So it doesn't necessarily mean that the tracking of it actually is a way to detect bad actors. I'm just wondering whether exchanges, as you consider the onboarding side of things, making sure that that's the right person, then the fact of the matter is that because the AML, the KYC is a continuous process, yeah. So which means that besides just looking at the ongoing aspect of it by transaction monitoring transactions, there could be pockets of areas whereby you may need to verify your clients again to make sure that this person that is sending this order to you is indeed the same person who's opened the account 6 months ago. Because like what Asman has said, there are people who's selling not just the KYC profile, but selling accounts out there. And it's very easy to and accounts are all with passwords and all. Of course, you put in two-factor authentication, and now these days you can even sell away the whole handphone as a package, right? This is the authenticator that is already bound to the phone. Or you can sell away the email as a complete suite, right? It costs nothing to create a Gmail account. So even if multiple MFA can actually be circumvented, is what I'm trying to say. And then, which means that to an exchange who wants to really, really go and address this risk, then you do need to consider how do you engage the customer to make sure that this person is indeed the same person who claimed that he is who he is 6 months ago. And that will mean that, like, go back to the commercial side of things, the cost of compliance to maintain an account like this is just going to shoot through the roof, which potentially makes this business to some people commercially unviable, unless you take the risk and you're saying, okay, I'm very risk seeking, I don't want to do this, and therefore I'm willing to accept that the person who sends in the order 6 months later may not be the same person, and you wear the risk.
Thanks, great points. Okay, let's move on. I don't think we have the answers to a lot of these issues, but we'll
something
to
think about as a
something
we don't have the answer. We don't have the answer to all the questions here.
Oh, we don't. I thought we are all the all-knowing, but never mind. Let's move on. Source of wealth and source of funds. Again, some of these mirror the fiat world, but there's some unique crypto-specific red flags. For instance, crypto addresses or bank cards connected to fraud, extortion, ransomware schemes, sanction addresses, darknet marketplaces. So again, you need to have a RegTech solution that actually packs to the sources of these transactions originating from or destined to online gambling sites. Again, gambling is a red flag. Use of debit credit card linked to crypto wallets to withdraw large amounts of fiat. Now we are seeing lots of these wallets. I mean, crypto is one of them. And apparently, if you withdraw large amounts of cash, that's a red flag in itself. Okay, we can talk about this. Deposits into an account or a crypto address significantly higher than source of funds. Again, that mirrors the fiat world. Lack of transparency, insufficient information on origin and owners of the fund. For instance, use of shell companies. And it flags the ICOs. ICOs where the personal data of investors might not be available. So in other words, if the ICO did not do AML or CFT, CDD, that is a red flag. So any funds coming from that ICO is now tainted. So if you're still contemplating ICOs, please bear this in mind. Funds sourced directly from third-party mixing services or wallet tumblers. So there are services like that out there. Okay, this is another point worth debating. The bulk of our wealth is derived from investments in cryptos, ICOs, or fraudulent ICOs, etc. So if it's a crypto-related, if you made your wealth through crypto, that is a red flag. So we can again debate this. Next, the source of wealth is disproportionately drawn from cryptos originating from VASPs that lack AML or CFT controls. So now these red flags are largely not covered in the MES guidelines. I think they may make their way into the MES guidelines, knowing how these things work. But to the panel members, any thoughts on any of these red flags? Are they being too broad brush?
I think the amount of data available to companies today dealing with virtual assets is just so much more than what was with fiat, right? When you look at some of these red flag indicators originating from or destined to, right? I think one question that then comes to mind is, how far back do I look, right? With virtual assets, as what you mentioned, we have this permanent audit trail where we can actually trace the origin of any public blockchain, right? So any Bitcoin, where it started from 10 years ago all the way till my client sends it into my exchange. And undoubtedly, you know, chances are that at one point or another, it had touched upon an illicit source, be it ransomware, darknet marketplace, or even gambling. And then to what level can I then attribute that to my client? I think that's the challenge that companies face today. There's not enough clarity as to how you attribute these risks at different layers, which then makes it difficult for exchanges then to design their policies, right? And then I guess the easy answer is always we take a risk-based approach as long as you can justify your approach when you are questioned. That's simple, but in actual fact, it's not as simple as that. And that's some of the challenges that we know our clients face through our conversations with them.
I would agree with you, and I mean that's something that we face as well. Don't forget that if we basically are in doubt in terms of the assessment, and basically to be safe, we'll probably make a report anyway. So you know, if it's in doubt, you probably make a report, because so therefore it's not a sufficiently good enough reason, I think. And I think some of this clarity that you alluded to, Ian, in terms of attribution issues and serious issues that we are facing with, in terms of making sure that we get the right assessment. And I think you know, further clarity, if any, would be very helpful in this space. Obviously, the other thing is in terms of when do you ask for this source of wealth in itself. Clearly, there are certain thresholds that you want to apply. And you know, obviously you would not ask if it's just $1,000 or a few $100s of cryptos in every exchange, because you want to take a risk-based approach. So a couple of further guidance or guidelines around this source of wealth measures would be very helpful. So if MAS guidelines were to cover that in the future, that's seriously one of the areas that I would, you know, suggest that they look into to give further clarity.
I think there need to be a little bit more understanding about what is source of wealth, what is source of funds, because the tools are completely different, right? Clearly, I'm assuming people know, but just for the sake of clarity, source of fund refers to where the money comes from to fund a transaction that you're performing on behalf of your client, or whether is it, you know, they're buying, sending in something to buy something else, right? So that's the source of fund for a transaction. Whereas source of wealth is, you know, to quite honestly, that's actually the holy grail of, you know, AML, right? But it's the holy grail that it will never be reviewed. The reality is that if you're an exchange, you're providing a brokerage service. Why would a customer be telling you where I get all my wealth from? Like, even banks don't get that information, unless to some extent you are, you know, and even to be quite honest, the fund managers or the wealth managers, they can ask for it. They can try and corroborate the wealth sources from public sources and whatnot, but they will never know with certainty this is the amount of wealth I have.
Yeah, I think again that depends on the threshold amount, because when we talk about hundreds and millions of dollars, then this question becomes very relevant.
Of course, certainly. So that's where there is a risk-based approach where if you have got clients of that nature, then you have to do enhanced due diligence and you have to ask a tons more questions. Whereas for your day-to-day, maybe your average customer, the concept of source of wealth question may not pop up in the first instance. And so I think that's where people need to make a distinction. Because firstly, there are two different things. And secondly, you're probably not going to get anything out of asking a client who trades regularly, maybe $10,000, $20,000 in your exchange, you know, and you're asking them where you get your source of wealth. They probably go to the next exchange, you know, and do the same thing.
Okay, I just want to focus on one of the red flags. That's the use of debit cards linked to crypto wallets to withdraw large amounts of fiat. I think a lot of customers actually, you know, get a debit card really for this purpose, because the difficulty is that a lot of the exchanges might not have bank accounts, you know, for customers, and the offering of a card by the providers who do have fiat bank account services is meant to assist the customers to therefore cash it out for whatever purposes they need to. Any thoughts on that? Do you think that this might be a little bit too broad?
I mean, it's a way of circumventing around the current rules, right? So I mean, if that's
No, it's
allowance
not to circumvent, Azman. I mean, and the point is, like it or not, the banks are, playing very hardball when dealing with crypto exchanges.
That's exactly it. But they are allowing a wallet to open with a debit card. That's what I mean. It's circumvent the commercial reality of the fact that exchanges are not allowed to open accounts, trading accounts for the bank. So it's a way of allowing you to still deposit and withdraw your fiat through a wallet, through a debit card or a credit card as well. So I see that as a means, but then you're paying only interest and fees for that, higher fees possibly.
Yeah, I suppose there's also a bit of like the questions around withdraw large amount. What constitute large amount is a threshold point that Azman was also mentioning. So that there need to be some kind of guidance. What amounts to large, and also depends on the card issuers themselves. What is the limit that is being issued typically to a card holder? Now, typically for debit card or credit card purposes, it's meant to be used for spending. So you're purchasing goods and services, and you can't go to if you're trying to launder money through this scheme, short of you going to the ATM machine and take out a chunk of cash through this means, that's a separate thing. But vast majority of why there's commercial reason of that, it's actually for people to spend money on Starbucks or whatever. If it's purchasing of goods and services, F&Bs, then I think that obviously wouldn't be a red flag. But if you're allowing people to withdraw large amounts of fiat out of an ATM machine with no threshold limits or whatsoever, then clearly that would be a problem.
Okay, any other thoughts on this? How about the point that where the bulk of your wealth is derived from cryptos? That's a red flag in itself. I mean, if you bought Bitcoin where one Bitcoin is the price of coffee and you made lots of money from it, and then you're not that terribly successful in investing in the stock market.
No, exactly. So that itself is not a red flag, and I think that can be proven if someone can show you the wallet that this one Bitcoin have come in 2009 or 2010, and then it remains as it is today, and then the value have gone up, exponentially. Then sure, that's a very easy proof that you can put on documentation.
Well, it's quite interesting, right? They lump VAs, ICOs, and fraudulent ICOs in one big bucket.
Yeah, true.
Yeah, it seems a little bit.
They're all tart.
Yeah.
Would you say?
I suppose those ICOs that are scams are tainting the rest of it.
Yeah.
That's probably the case.
Yeah. Again, I don't know. I mean, you get a sense that somehow that there is still an underlying, what's the right word for this? Suspicion.
Distrust.
Stereotype
discrimination.
All things cryptos being bad. I think you get a sense of it.
Because of the fact that they've really labeled it as high risk. You come into being as being very dangerous. So, you're going to face all of these challenges. I think we have to live with it until, we can prove that it's otherwise, that we have the necessary controls, that we have able to monitor and we are able to manage the entire thing. But we will have to see in the future, I think. But it's proven with this recent case. I'm sure everybody is aware about the banking case. Banking has been with us, for whatever hundreds of years, and the fact that they are the biggest one are laundering money in trillions of dollars, suggests that whatever controls that they have in place are not working.
That's the irony, isn't it, Azman? I mean, the FinCEN. I think you're referring to the FinCEN leaks, and even Singapore banks are involved in that. Quite a bit of interest by the media on that, and it just shows that the number one instrument for laundering still remains fiat currencies. The US dollar is one.
If I have to advise a mafia or a don in terms of how the best to launder money, is still cash, not cryptos, man.
Yes,
it is.
Right.
People shouldn't be under any kind of an illusion that money laundering wasn't invented by banks.
Okay, let's not get there.
I think it's an important enough point to make
I didn't see
maybe
which
we
bank
are,
though.
we've been unfairly discriminated, I think, as an industry. So they need to take a step back and, look at us in its on our own merits, basically.
Okay.
Yeah.
The further irony is that some of us used to be in banks, but let's not get there again. Okay, let's move on. The last chunk of red flags is on geographical risks. Again, there are some specific, this is not entirely new, jurisdictional or geographical risks, but there's some very specific references to crypto issues. One is the funds, whether they come from or are sent to an unlicensed exchange, or in a jurisdiction where it's not licensed, where you utilize an exchange in a high-risk jurisdiction lacking or having inadequate AML CFT regulations. So that's pretty interesting. Again, that might have an impact on your compliance program, or if you use a RegTech provider, whether you actually look out for exchanges which come from higher risk jurisdictions. You send cryptos to exchanges operating in jurisdictions that have got no regulation or have got not implemented AML CFT controls. So actually, right now, it means that you therefore need to actually verify whether the exchange you are dealing with have got a compliance program. And then finally, where the customer sets up offices or moves offices to jurisdictions that have no regulation or not implemented regulations governing cryptos, or you set up offices in jurisdictions where there is no business rationale to do so. So again, these are quite interesting. And these are not covered by the existing MES guidelines. So any thoughts from the panel on these red flags?
I think we are probably all aware that FATF does issue periodic assessment on some of these countries where they assign whether they are high risk or low risk, or lacking in some of the regulations and standards, and therefore they assign a higher risk rating. And that's something that I think as part of the screening process, and I'm sure Ian or Merkelstein will be able to comment on this in terms of to the extent in which those are highlighted, and so it becomes then part of the normal screening process. The other thing is obviously the importance of them, where they are tracking the domain, where they are using their we were mentioning earlier on about the use of domain, what was that, that thing that
DNS.
you can switch from. Yes, DNS, that's the one.
Yeah.
That's the one. Yeah, so that's the other position that we need to address and assess internally. So yeah, those are my thoughts on this geographical risk.
Ian, your thoughts. Are there solutions out there which actually blacklist or whitelist exchanges based on the strength of their compliance program?
Yes, for sure. So, first thing I want to say is jurisdiction arbitrage is very common in the crypto space, right? We see exchanges set up operations in many different locations, with even some exchanges who will never come out and publicly say where they are located, right? So that they can't be questioned and can't be subpoenaed accordingly, right? So dodging that. And then on top of that, now we've seen a lot of decentralized exchanges, DeFi projects come into the space, which makes it, again, much harder to narrow down. But to answer your question, yes, providers like us in the space, not only do we go out and build databases of, let's say, exchanges, darknet marketplaces, ransomware, we've seen a need to actually further categorize these, what we call entities, into subtypes, right? Because I think what you've mentioned and what is said here in the red flag indicators, yes, we do want to take note of exchange of businesses set up in countries that don't have AML and CFT regulation, but at the same time, there are many businesses out there which may be in a jurisdiction which requires, which has AML and CFT regulation, but they still don't implement it anyway, right? So conversations with our clients, we've had one group of clients say to us, okay, I want you to subcategorize based on whether or not they have AML and CFT policies. And then another group of clients that says, actually, I don't care if they have or don't have. All I care about is whether or not they're licensed, right? Because from my standpoint, as long as I can answer my regulators that I'm only dealing with licensed exchanges, which I can then assume that they have AML and CFT programs that meet what is expected, then I'm protected. right? So definitely there is a need today, I think, to go down deeper into not just identifying the name of the business they are dealing with, but taking a look at their AML and CFT program. And I think the beauty about blockchain transaction monitoring is that regardless of what the business is, whether or not they have AML and CFT programs, companies like ours can actually validate whether or not these businesses are following the AML and CFT programs that they say they are, because we can actually independently verify if they are processing transactions from high risk addresses, irrespective of what they say, right? Because all this can be independently audited on the blockchain. So I think this level of transparency is very new. And in fact, we've been in talks with a couple of regulators as well, in terms of providing this kind of independent assessment on these exchanges, businesses, to verify if they are putting in practice the kind of policies they say they have in place.
Yeah, it does appear that there's a lot of focus on exchanges and the strength of their compliance program. Okay, but I'm just very conscious of the time because we're crossing the 1.5 hour mark. But I think it's been a lively discussion so far, but I think we're going to wrap up anyway. And a poll question, the first poll question is, the third poll question rather, do you think the red flags report was useful in understanding the money laundering or terrorist financing risks of cryptos? Kevin, can you run the poll? So the options, a little, very useful, or not useful at all. So your votes, please.
It's probably another 15 seconds.
Very precise in your timing, Kevin. You should be the returning officer for the next general elections.
I would love to. Okay, I think there we go. Stopping, sharing. Interesting. So I think mostly people find it useful.
No, I think it's good that that people find it useful. If anyone to find it not useful, then it would bother me a lot.
So, no, this got nothing to do with this committee. I'm sure we're not running a poll question whether you think this session was useful. I'm sure it'll be overwhelmingly yes, but it's whether the report was useful. But this is where we come in.
The red flags are certainly very useful, and it should receive some attention for anyone who's in the BASP space.
Okay.
But I agree with you, but I thought that more clarity would be even more helpful. That's my perspective, yeah.
Okay, and that brings us to the, where we go from here. I think when we said earlier that we don't have all the answers yet. But I think we asked ourselves this question, how as a committee, operating within a blockchain association, and this report, very squarely affects our constituents, right? How this committee can add value. And I think one of the ideas that was tossed up was whether we can help create some form of industry standards for ongoing monitoring, or not just ongoing monitoring really, but TDD as well, transaction reporting based on the red flags report. So it helps people to implement processes, controls, compliance framework to comply or to mitigate against some of these risks. That's one. Two, we were also thinking about training for C-suites of intermediaries that are licensed, crypto intermediaries in particular, or whether some form of a compliance training which is very focused on AML risks of cryptos would be helpful. So these are just some ideas that we thought of, and any others that you can think of. You can use the chat functions if you have any ideas on this. But let's run a quick poll so we can get a sense of how you think we can add value. The poll question is, what would you like us to do going forward? And Kevin, if you can run the last poll, that'll be great.
Okay.
Yeah, unfortunately, it's either or. So, I should have put C, which is both, but yeah, I mean, just a sense of where you think the priorities should be. Returning officer?
Okay, we're gonna stop in counting 5, 4, 3, 2, 1. Okay, there you have it. The result is out. So I think majority are very, very much keen on developing the industry standards, that, or rather the CBS should be taking the lead in doing that. Yep.
Fantastic. And of course, if you have any suggestions, please use the chat function. I know there were some comments taking, okay, someone suggested list of RegTech providers that can ensure VSPs.
Check your modem or router connection.
Comply could be useful. Okay, that's some form of a verification process, or what's the right word for you? Accreditation process, I think. Yeah. Okay. Thanks for that suggestion. Okay, I'm just very conscious of the time, but thanks so much everyone for sticking around for the last 90 minutes or so. If you have any burning questions, you can just drop us an email. Kevin, maybe you can type the email address in the general chat.
Nizam, can I just make one quick point about the RegTech list?
Sure.
Outside of the BAS itself, under the Singapore FinTech Association, I chair a RegTech subcommittee. We've recently published the RegTech landscape map or ecosystem map that you can go and look it up under Singapore FinTech Association's website. It does include a number of RegTech providers across multiple verticals within the RegTech ecosystem. So people like Merkle Science and ourselves are on it. And there are others. So it depends on what verticals you're looking at. And if you've got any specific question, just feel free to reach out to any one of us. We'll hopefully be able to point you to the right direction.
And on that note, Chak, it also worth mentioning that we're having a joint event with the FinTech Association on the MES paper that talks about conduct risks and
individual accountability and conduct. Yes,
that's right.
So that's something in October.
Yeah, do keep a lookout for that. That's going to happen pretty soon. Okay, so Kevin just put in the email, hello@singaporeblockchain.org if you have any further questions or comments. Yeah, but thanks very much for your attention. I will stop sharing now. Kevin, do you want to say any final words?
I think this has been a very great session, and I think to the public, to anyone who's a fan of obviously the subcom, as well as the public who just got in today, just be aware that you will definitely be a more series of webinars similar to this to really look into this area, because I think it impacts lots of folks, and as well as people who are curious how it can actually impact their business in the future in the area of compliance, as well as FATF rules, as well as potentially some other regulations that's going to come out with the local regulators, mainly MAS, right? So yes, look forward to that. We'll be sending things out to you whenever there's such an event coming out. So I think with that in mind, thanks for joining. Great session. Feel free to send your questions to us by the email that's posted in the chat group, and we'll try our best to answer back to you. Thank you.
All right. Thanks, everyone.
All right. Thank you.
Bye.